Imagine you're at a dinner party, and a guy casually mentions he just bought SpaceX stock. He sounds incredibly proud, explaining how he used a special online platform to invest $40,000. Everyone at the table looks at him with pure envy. He feels like a financial genius who just secured a piece of the future. He should be sitting on one of the greatest private market investments available today. Instead, there is a painful contradiction. He has no idea what he actually bought. He cannot sell his shares if he needs cash tomorrow, and he holds absolutely zero real claim within the company itself. Something is deeply wrong with this picture. Most people believe that getting into SpaceX before its public IPO is the closest thing to buying Amazon back in 1997. But here is the major gap. Almost no one buying this special SpaceX access is actually buying real SpaceX stock. There is a massive, hidden gap between what you are told you own and what you legally hold. I spend my time analyzing complex private market structures to see where the money really goes. If you want to understand what you actually own before you wire your hard-earned money, subscribe and hit the like button if this helps. It is completely natural to think that buying into SpaceX right now is a brilliant move. Today, normal investors can access this private giant through online investment platforms, special purpose vehicles, pre-IPO marketplaces, and unique access funds. Wanting a piece of this action isn't foolish at all. SpaceX is an incredibly real, highly valuable, and fast-growing company that is actively changing the world. It makes total sense that you would want your money to grow along with it. But here is where the crack in that belief begins to show. Almost none of these popular platforms are selling you direct shares of SpaceX. Instead, they are selling you membership units in a small, private fund. That fund often just holds units in a completely different fund, which then finally holds the actual shares. When you peel back the layers, you realize a shocking truth. You are not buying SpaceX. You are simply buying a position in a very long line, and you have no idea how long that line actually is. To understand why this happens, we need to look at a specific idea that I call the custody gap. The custody gap is simply the distance between what you believe you legally own and what you can actually prove, control, or sell. Most everyday investors never see this gap because the sign-up paperwork is incredibly long, dense, and confusing. The financial platforms specifically designed these documents so the truth is buried deep inside complicated industry words like feeder funds, special purpose vehicles, or fund of funds. You think you are buying a rocket company, but the paperwork says you are just buying into a heavy chain of middlemen. From this point on, everything we look at in this video will make sense once you view it through the lens of this hidden gap. Think of it like renting a nice apartment from someone who is actually renting it from another person who is renting it from the real landlord. You are essentially subletting a sublet. In this situation, every single middleman along the way takes a small cut of your money. You have never actually met the true owner of the building. You do not have your name on a real lease. And if any single link in that long chain suddenly disappears, you have absolutely no protection. That is exactly the hidden structure of most SpaceX investment offers today. There are multiple invisible landlords standing directly between your cash and the real shares. Let us look at the actual numbers to see how this works. Imagine you decide to invest $25,000 into one of these special SpaceX platforms. On paper, you assume all $25,000 goes straight toward buying rocket shares. But behind the scenes, a process called fee stacking begins to eat away at your money. First, the online platform takes a 5% setup fee, which instantly removes $1,250 of your cash. Then, the first middleman fund charges a 2% yearly management fee. Below them, the secondary master fund takes another 2% management fee. On top of that, both layers lock in a 20% carried interest fee, which means they take nearly a quarter of any future profits you might make. When you look at the contrast between your stated investment and your actual dollar exposure, the reality is shocking. Instead of $25,000 working for you, only about $21,000 ever buys real SpaceX equity. The rest is trapped in markup and platform fees. Now, look at a 7 to 10 year timeline while you wait for the company to finally go public. Because you bought in at a heavily marked up share price through these middlemen, your money has to grow twice as fast just to break even. Over 10 years of being completely locked up with no way to sell, that extra fee markup compounds heavily against you. When you add up all the layers, the final striking number is 84. Only 84% of your money ever touches an actual SpaceX share, while 16% is handed directly to the middlemen before a single rocket even leaves the launch pad. Let us look at a real-world example to see how this plays out for a normal investor. Meet Marcus, a 38-year-old senior software engineer who earns a good salary of $165,000 a year. Marcus reads a popular finance newsletter one evening and sees an exciting opportunity to buy into SpaceX before it goes public. He decides to invest $25,000 of his hard-earned savings, truly believing he is getting a head start on the ultimate stock market winner. But underneath his investment, a massive hidden structure is quietly operating. Marcus sends his money to an online tech marketplace. That marketplace passes the cash down to a special purpose vehicle, which then passes it to an entry fund, which finally hands it to a late-stage master fund. That is 4 separate layers of middlemen handling his cash before it ever reaches a share of stock. For the first couple of years, Marcus thinks he is completely fine. Every 3 months, he receives a clean quarterly statement in his email showing that the company's valuation has gone up. He feels smart, validated, and incredibly proud of his financial choice. The real problem hits in year 3. Marcus decides he wants to buy a home, and he needs $40,000 for a down payment. He logs into the platform to sell his $25,000 investment. It is only then that he learns the painful truth. Because of the multi-layer fund structure, Marcus has 0 transferability rights. He cannot sell his position on an open market, he cannot transfer it to another investor, and he cannot even get a legal document from SpaceX verifying that he actually owns a single piece of the company. His money is completely trapped, and he is left with nothing but a digital screen showing numbers he cannot touch. This happens because of a powerful psychological trap called the mix of scarcity and the halo effect. When a platform offers you exclusive access to a highly famous company and a legendary founder, your normal financial caution completely short-circuits. This trap operates entirely below your conscious awareness. The deep emotional desire to casually say the words, "I own SpaceX," completely overrides your natural instinct to verify what that ownership actually means on a legal document. People willingly skip reading the long, boring fine print because the overall story feels simply too good to question. You want to believe you are part of a grand mission, so you ignore the red flags. But it is important to reframe this situation clearly. This is not a story about Marcus being careless or foolish with his savings. Instead, it is about a highly sophisticated financial structure that is intentionally designed to make extreme complexity look and feel like elite prestige. The system weaponizes your natural optimism and excitement for the future, turning a web of confusing middlemen into something that feels like an exclusive, high-class club. Let us look at the big picture one final time. Popular belief says that simply gaining access to a massive company like SpaceX is the ultimate financial win. But the sharp, contrarian truth standing right beside it is much different. Ownership with no legal rights, no power, and no way to sell isn't actually access at all. It is just a really expensive story to tell your friends at a dinner party. The popular investor ends up owning a completely locked asset that feeds someone else's big dream, while the smart investor keeps their money in clean, direct assets that build their own freedom. The truth is simple, and it is something you should always remember before you invest in these private hype markets. The number of people standing between you and the real shares matters far more than the size of the check you wrote. Same starting cash, but 2 completely different outcomes. If you are thinking about putting your money into a private tech deal right now, there are 3 specific actions you need to take this week. First, pull up the actual offering or subscription documents and use the find tool to search for 3 specific words: feeder, SPV, or fund of funds. Count exactly how many separate business entities sit directly between your bank account and the real SpaceX equity. Second, look at the fee section and add up every single disclosed fee layer. Do not just look at the main platform fee. Add up the management fees and the carried interest percentages for every single level you discovered in your search. This will allow you to calculate your real effective exposure per dollar invested, showing you exactly how many cents of your dollar are actually buying stock. Third, locate the exact liquidity terms in writing. Confirm whether the platform has an actual, active secondary market where you can sell your position, or if your cash is completely locked away with no defined exit date. Taking these steps changes how you interact with the financial system. At the end of the day, ownership you cannot verify or control isn't true ownership at all. It is just an expensive story you are renting.